The Dunkin IPO is coming, and investors are going to line up for it. But here's the problem. They're not buying Dunkin', they're buying Arby's, they're buying Sonic, they're buying a multi-billion-dollar debt load wrapped in a pink and orange box. This is the IPO story of Inspire Brands, and most investors won't read it until it's too late. Here's what's true. Dunkin' looks like a solid brand. Consistent traffic, loyal customers, strong unit economics, but Dunkin' isn't going public alone. It's going public inside a holding company called Inspire Brands, a private equity roll-up that also owns Arby's, Sonic, Buffalo Wild Wings, Jimmy John's, and Baskin-Robbins. And here's the reality. When the market puts a public price on Inspire, it will also put a public discount on every brand that isn't Dunkin'. That's the trap, and we've seen it before, but investors are about to walk right into it. Stay with me, because the pattern here is hiding in plain sight. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. Bill personally researches and writes every video script himself. I hope you enjoy. He reads every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Let's get into it. Here's what really matters. This isn't about whether Dunkin' is a good business. This is about whether Inspire Brands, the entity you would actually be buying, deserves the premium that Dunkin' alone would command. If you're a serious investor looking at this IPO, you need to understand the multi-brand discount. You need to understand why every major consolidator from the 2018 to 2020 era has either stopped buying, started selling, or collapsed entirely. And you need to understand why this IPO was designed for a world that no longer exists. That's what we're going to cover today. Let's go back to 2018. Private equity was in love with restaurant roll-ups. The thesis was simple: buy multiple brands, centralize operations, layer on debt, cut costs, and create portfolio synergies. It sounded institutional. It sounded sophisticated. And for a brief window, it worked. RBI, Restaurant Brands International, was the darling of the space. They took Burger King, added Tim Hortons, added Popeyes. Wall Street loved it. Yum Brands had KFC, Taco Bell, and Pizza Hut running under one roof. Multi-brand efficiency, shared infrastructure, the model had logic. Then something changed. The market started asking a harder question. Not can you run multiple brands together, but does running multiple brands together actually create value, or does it just obscure which ones are destroying it? That's the key insight. Consolidation doesn't necessarily create brand strength. Sometimes it hides brand weakness. And the public market, once it has a live daily price on your portfolio, is very good at finding the weakness. Here's the context. Arby's has struggled in recent years. Reports from 2025 highlighted declining sales and a string of store closures. Sonic has faced a similar dynamic. Those aren't catastrophic details on their own, but when you pair them with a brand like Dunkin', which has real consumer loyalty, growing digital engagement, and positive traffic trends, you have a problem. It's called the conglomerate discount. Think of it like this. If I handed you a portfolio of stocks, one great stock and three mediocre ones, and told you the price was set by averaging them all together, you'd be frustrated. Because the great stock deserves a premium, and the mediocre ones would drag it down. That's exactly what happens to multi-brand restaurant operators. The market doesn't reward the Dunkin' inside Inspire. It prices the whole portfolio, and the whole portfolio includes Arby's and Sonic, and a company that took on billions in debt to build this thing. We've watched this play out again and again. Fat Brands, which tried to build a mini version of this model, filed for Chapter 11 bankruptcy in January 2026. Jack in the Box sold Qdoba to focus on a single brand. Why? Because the conglomerate structure was suppressing their multiple. RBI spent years trying to fix Tim Hortons, and while they eventually turned it around, it took a decade and cost serious attention and capital. Here's the reality. When you go public with a multi-brand structure, the market will find your weakest link, and it will price the whole company accordingly. So, what do you do with this? First, don't let the Dunkin brand pull you in emotionally. Dunkin is a solid business. That's not the question. The question is, what am I actually buying at the IPO price? Here's how institutional investors think about this. They look at what Dunkin alone would be worth. As a pure-play franchise business with its royalty streams, digital growth, and unit economics. Then they apply a holding company discount, typically 15 to 30%, for the complexity, the debt, and the drag of the underperforming brands. If the IPO is priced at Dunkin's pure-play value, without that discount, you're overpaying from day one. That's the trap. Second, watch the debt. Inspire was built on leverage. The buyout model requires it. But going public doesn't retire that debt. It just gives the PE sponsors a path to exit. Higher interest rates change the math on leveraged restaurant operators dramatically. A business that looked like a cash machine at 3% rates looks very different at 5 or 6%. Third, ask the portfolio question. What is Inspire's plan for Arby's and Sonic? Are they growing? Are they being repositioned? Is there a credible path to improved unit economics? If the answer isn't clear and specific, that's a yellow flag. It may even be a red one. And fourth, and this is important, understand the timing. Inspire is going public, right as the market has concluded that multi-brand restaurant operators are structurally difficult to own. The era that created Inspire, the 2018 to 2020 consolidation wave, is over. The acquirers that validated this model have moved on. Some have stopped buying, some are selling, one is in bankruptcy. This IPO was designed for a different market. The window that made this thesis work is narrowing, if not already closed. That doesn't mean the stock can't go up on day one. Hot brands attract buyers, but it means you need to take a hard look at the long-term fundamentals and whether or not they support the premium valuation that the Dunkin halo may generate at open. Now, I want to be fair here. There's a bull case for Inspire. The bull case says Dunkin's digital engagement is growing. Loyalty program members are up. The brand has pricing power in a value-conscious consumer environment. The bull case also says Sonic has a drive-through model that plays well in the current footprint environment, and the operational infrastructure across brands creates real shared cost leverage. Those aren't wrong arguments, and if you believe that Inspire's management team can execute a credible portfolio optimization, divesting the weakest assets, reinvesting behind the strongest, there's a scenario where this works. But here's the discipline I've built over 3+ decades. The burden of proof is on the company, not on the investor. When you go public with billions in debt, underperforming brands, and a PE overhang, you don't get the benefit of the doubt. You earn it, quarter by quarter. My concern isn't that Inspire can't build value. My concern is that the IPO price won't give you credit for the risk you're taking to find out. Let me bring this together. This is not the Dunkin IPO. It's the Inspire brand's IPO. And those are two very different things. Here's what really matters. The market will price this company, and it will price all of it, the great brand, the struggling brands, and the debt that sits underneath them. History says that price, over time, will reflect the weakest link, not the strongest. Decision quality is the job, not excitement, not brand recognition, decision quality. If the IPO price reflects Dunkin as a pure play premium and doesn't discount for the full portfolio risk, you're paying for an outcome that history says is unlikely to materialize. Remember, this is not about chasing headlines. It's about building a system that works when the noise fades. If you want institutional-grade analysis on deals like this, including the ones the media doesn't dissect, subscribe to this channel, like this video, and drop a comment below. What's your biggest question about Inspire Brands' IPO plans? Inspire Brands' IPO means you're not just buying Dunkin', you're buying everything else that comes with it. And right now, the market hasn't fully priced what that means.